serve over 100,000 participants, and that's a lot. That's a lot of folks, and that number includes active clergy, retired clergy, and a real important group, surviving spouses of those clergy. So that's a real big number, a lot of assets, and these things make us the largest reporting denominational fund in the world. But why do we do this? Why do we get up? Why do we go to work? Why do I travel? Really, our mission at Wespath, very clearly defined, is to care for those who serve. And it's not just about retirement plans. That's going to be my focus this morning, but it's also about healthcare plans, wellness plans, death benefits, disability. There's all these different types of plans, but the focus today at the retirement seminar for the retiring class is going to be on the retirement plans. And that's the first bullet we have on our agenda. These assets introduce you to a life stage retirement income service. You might be familiar with life stage investment management. We do have a brochure which describes all the life stage services, but this one is important because it focuses on how to get money out of your plans as opposed to how to manage money that's already in your plans. I'm going to go into the housing allowance exclusion, and that's a really, really important tax break for retired clergy. And I'll give you some examples, and I think the examples are helpful. And I know it's been something that's been challenged in the courts and probably will continue to be challenged and has been upheld. And I'm going to give you a couple of the different considerations in that housing allowance exclusion. We do have a worksheet in your folders that we'll look at as well. I will cover briefly the Comprehensive Protection Plan, or CPP as we call it, which is a death and disability program. Some of you might be eligible in retirement for a death benefit for you and your surviving spouse. Then I'll go through the process of applying for your retirement benefits. Here we are in April, right? Getting toward the end of April, April 29th, okay? This is important because we have time to take this stuff home, share it, and discuss it with your spouse or someone you trust financially. Pray on it, make these decisions, and knowing that, if you make your decision, let's say May 6th, and if you wake up May 7th and you've changed your mind, that's okay. It's not too late. You really have several weeks. Please don't wait until June 30th to do this, okay? Not a good idea. You can, technically, but don't, because things happen. You know this. You could lose electricity or internet connection or not be able to log on. And it doesn't mean you won't get benefits because you didn't do this by June 30th, but it does mean they're going to be delayed, and I don't want that to happen. So if all goes well, and I must say, in this retirement season, my luck with technology has been terrific, okay? Meaning that I've been successful 100% this season in getting into our VPN, getting a good Wi-Fi connection so that I can show the retiring class a benefit access demonstration, which is, I think, really helpful. A lot of folks have told me they like seeing it. I'll walk you through the actual screens that you're going to look at, take you through the different information that you're going to have to provide. We'll do that both for the defined benefit, lifetime income, as well as the cash account balance. It's just a lot of fun. And I tested it, and it seems to be working, so we'll wrap it up with that benefit access demo. But certainly ask questions as I go through this material. Let's begin by focusing on these retirement plans. You're going to receive money from Wespath. The thing about retirement income is what you're really trying to do is replace the paycheck that goes away, right? Eventually they will stop paying you, right? So the challenge is, how am I going to replace it, and where's it going to come from? Well, it's going to come from different places, different plans, different sources, including maybe you have eligibility for Social Security retirement benefits. Nothing replaces your whole paycheck, but these plans replace parts of the paycheck that goes away. Now, some important provisions for retirement outlined in the Book of Discipline. There are different types of retirement, and you might have a good idea right now what one you're looking at. The most common one we see is your normal retirement. And folks, I'll remind you there are copies of these slides in your folders. I just point that out because, last week I saw someone taking a picture of the screen, and I said, well, that's nice, but you don't really need to do that unless you want a picture of the speaker. You don't need to do that. We do have nice copies of the slides. But normal retirement is the most common one that we see. You've reached the age of 65 or 40 years of service. That's considered a normal retirement. Early retirement is available as early as age 62 or 30 years of service. Anybody looking at an early retirement here? Some of you, okay, good. Who's looking at normal retirement? Okay, more normals, okay, that's expected. Mandatory retirement is when you reach the age of 72. Anybody looking at a mandatory retirement, okay? And the fourth one, we don't see it as often, but it's called a 20-year retirement, where the clergy person has served for 20 years, separated from the denomination for whatever reason, and they will come back at a future date to collect a benefit from Westpath, either at age 62 or waiting anywhere in between that and age 65. This chart I really like, and we're going to see this several times this morning, and it's going to have a white arrow pointing to the plan that we're going to be talking about. And it's very colorful, and it has the names of the different benefits. And I mentioned I always like to start with where we exist right now. CRSP, Clergy Retirement Security Program. Some participants call it CRSP, and I understand what they mean. Okay, and you'll see two different boxes for CRSP for two different periods of time, two different periods of service. And I'll explain when we get into CRSP why there's two different boxes, how the formula changed. We'll also look at the two very important but very different components of CRSP, the defined benefit and the defined contribution. And I'll explain very clearly what the differences are and what the decisions you will need to make with those two different components of CRSP. Prior to that, you existed under the Ministerial Pension Plan all the way from 1982 through the end of 2006. Okay, so we'll talk about MPP. What are the choices, including doing nothing with MPP at your commencement date. And then we'll go back in time to what is now called the Pre-82 plan. They didn't call it the Pre-82 plan at the time. They call it the Minister's Reserve Pension Fund. And does anybody have a Pre-82 benefit coming? Yes, you do. Wow. And I've been saying since I started to my colleagues, hey, Peter, eventually these seminars will get a little bit shorter, right? Because we won't have to do Pre-82. And he goes, yeah, but that might take some time. And he was right, because we still see a lot of clergy retiring and ultimately receiving Pre-82 benefits. And then off to the side, you see that green circle. That's the United Methodist Personal Investment Plan. Some participants call it UMPIP. That's the plan I do participate in. I'm not clergy, so I don't have anything on the left, but I do have UMPIP, that green circle on the right. And that's an important benefit. We'll look at the different options, the different sources of money in your UMPIP. Now, when I joined the General Board of Pension in 2014, I had been in the retirement business for a long time, probably close to 25 years, and I had seen a lot of defined benefit pension plans. And I know how they work. And I know how valuable they are for participants. I know how costly they are for employers. Why are they valuable? Defined benefit plans give you a monthly paycheck or direct deposit that lasts your lifetime. And if elected at retirement, that benefit will continue to the surviving spouse. So really lasting two people's lifetime. You can't outlive your defined benefit plan. If you live to be 103, you'll still get your monthly direct deposit. You might forget who's sending you the money or where you worked, but you're still getting the money. That's important. Okay? And on the other side of CRSP is the defined contribution component. And I had also seen a lot of defined contribution plans like 401ks, 403bs, 457 plans, and I understand how they work. And they're quite different. They're an account balance. you have a lot of flexibility and control with that account balance. But when I got to the general board, I had never seen a plan that combines them both together. The advantages of a defined benefit plan and the advantages of a defined contribution plan. Truly a hybrid plan here, okay? Very interesting plan that gives you the advantages of both. Now, does everybody get quarterly statements? Am I the last one getting them in the mail? Good for you. Good for you. I happen to like paper when it comes to quarterly statements. I like to read the statement. I like to take it with me. I like to have several statements with me. I like to look at the investments. But what I'm trying to point out to you is that on your quarterly statements, whether you get them electronically or paper, it doesn't matter. What you don't see on your statement is CRSP, CRSP, Clergy Retirement Security Program, defined benefit. It's not here, so don't even look for it. And sometimes people will ask me, a reverend will ask me, Bob, where's the balance in my pension? I say, I don't know. You don't have a balance in a defined benefit plan. You have a formula, math, that's used to calculate your benefit. That's why they're referred to as defined benefit. Your benefit is defined by a formula. Was that good or bad? Well, I think it's good, because it means that the participant and the spouse are not subject to any market risk with that benefit. Market goes up, well, that's nice. The math didn't change. Market goes down, well, that's nice. Math didn't change. Your defined contribution account does appear on your quarterly statement, is subject to market fluctuations, and does give you a lot of control and flexibility with how you ultimately take it out of your account. Now, I always tell the retiring class, I think it's a good idea to focus on the defined benefit decisions first. Those are important. Those are decisions that are not revocable. I mentioned if you make your decision May 6th and change your mind May 7th, that's fine. But let's say several months into retirement, you change your mind. So you pick up the phone, right? You call Westpath and say, hello, Westpath, I've changed my mind on the defined benefit plan. I talked to my spouse now, we understand it a little better, and we want to change our mind. So we're going to pick a different option. What's the answer going to be? No, you can't. So I always say take care of that first. Those decisions are important, and they can be kind of complex. Figure that out first, and then the other stuff is easy. The defined contribution account balance is easy. It's going to be there when you're ready to receive it. So let's look at the more complex piece first, the defined benefit piece. It's math. We're going to be multiplying 3 different factors together. And one of those factors is called the denominational average compensation, or DAC. And if you look at all of clergy throughout the denomination, all the annual conferences, those serving in full-time appointments, this is the average of their plan compensation. And what we have seen over the years is growth in the denominational average compensation. We calculate this 2 years out, so we know what the DAC is going to be for this year's retirement class as well as next year's retirement class. Here is the formula for the first piece of service. Okay, CRSP started January 1, 2007, and through the end of 2013, it existed under this formula. Due to General Conference of 2012, the formula changed, and we'll look at that. Now, on the right, we have an example, and it might look, worse than it is, but I'll walk you through it. The bullets on the left are important. This is what we're going to be multiplying together for the first part of service. 1.25% multiplied by the denominational average compensation at the time of your retirement, and then multiplied by the years of creditable service during that period of time. So let's do that together. On the right, we have an example for a 2019 retirement. We're going to multiply the DAC times 1.25% times 7, the 7 years, full years of service, and we get this annual number, 6,244. So we got that number at Westpath, and we say, wait a minute, pensions aren't paid annually, they're paid monthly, So we'll divide that by 12 to get a monthly amount, in this example, $520 per month. So we hold that number, and then we say, wait a minute, we got to look at service now beginning January 1, 2014. And if you look at the next slide on the left, not a lot changes, but that first bullet, 1.25%, goes down to 1%. Could they change the plan to make it more sustainable going forward? Okay, the math didn't change though, so we're going to multiply the same DAC times 1% times the additional years and months of service, 5.5 years, to come up again with an annual amount. Divide it by 12, we figure out a monthly amount. So now we have the two pieces of CRSP service. We will add them together to come up with a monthly benefit. And then the decisions that you make about that benefit will impact what that amount is going to be from your benefit commencement date, July 1. Those decisions are important. What surviving spouse benefit do you want to provide? You have 6 different options. What cost of living adjustment, referred to as a COLA, which is an annual increase in your benefit. COLAs are good. COLAs are important. I have seen pension plans that don't have COLAs, and that's not good. Because I think we all know, and we'll talk about inflation, that $1,000 a month today is not the same as $1,000 a month 5 years from now, 10 years from now. If anybody is going out, and some of you indicated you're looking at early retirement, you receive a reduction in your benefit because of the early commencement. How much of a reduction depends upon how early the early retirement actually is. The way it's calculated is as follows. You get reduced 0.5% for each month that the commencement is early. So if it's 1 year early, that's a 6% reduction. In this example, it's 2 years early. The clergy does not have the 40 years of service, or we wouldn't be looking at early retirement reduction factors. So in this example, there's a 12% reduction, bringing the benefit down to $745, and then the decisions are made about COLAs and spouse or other contingent annuitant surviving benefits. Okay. Does that make sense? The math there. When we talk about the ministerial pension plan, we're going to go through the options, the annuity options and the COLA options that you have that pertain to both Clergy Retirement Security Program and ministerial pension plan. And the decisions that you make for one plan don't have to be the same as you make for the other plan. They could be quite different, and we'll look at that in a bit. Now, the defined contribution component of CRSP is very straightforward. This is a cash account balance, and this is made up of both matching and non-matching contributions, okay? Everybody was receiving a 2% non-match, 2% of plan compensation, and it's called a non-match because you don't need to do anything to get that. It's put into your account, an account balance. For those that have been contributing, which is a very high percentage for a voluntary plan, contributing to UMPIP, United Methodist Personal Investment Plan, you've also been receiving an additional up to 1% matching contribution for a total of 3% of your plan compensation going into CRSP defined contribution. And again, that is a balance that appears on your quarterly statement, plus whatever you have on the right-hand side in UMPIP, whether those contributions were before tax, after tax, or some of you were making Roth contributions. But the first choice that you have with the CRSP DC is to do nothing. And this is going to be a common theme this morning with some of these account balance plans. You don't need to do anything right away. You might need to do something right away. You might need this money right away for different purposes, for monthly income, for a down payment on a home, or for repairs or expenses on a home you're thinking of purchasing. But these DC balances are made up of plan sponsor contributions directed by the participant. You might be using LifeStage Investment Management to manage that money, or you might be self-managing. And you really don't need to do anything until you reach the age of 70 and a half. And that's a common theme this morning, too. That's when the government will lose its patience with you, and they want you to start taking something out of these accounts. And I will explain a lot more this morning about 70 and a half and required minimum distributions. But the big difference between these two components is defined benefit is a monthly check. Lifetime benefit continues to a surviving spouse. COLA increases. CRSP-DC is an account balance. You could take this all out at once. You can. You want to think about that very carefully from a tax and financial planning perspective, but you are allowed to do that. You can take out partial distributions. You can roll this money over into UMPIP consolidated and use life stage retirement income to calculate how much we think you can take out on a monthly basis. On the right-hand side, the DC, if you die, any remaining balances in your account don't go to Westpath or to the annual conference. They go to your designated beneficiary. So during your active ministry as well as in retirement, you always want to keep those beneficiary designations current, up to date. Does that make sense? Any questions about CRSP? Just one thing I'll mention on the right-hand side, if you decide, hey, I don't need this money right away, it doesn't mean that your balance that day is frozen or sitting idle. It's still fully invested, whether that's self-managed by you deciding where to invest it or in life stage investment management. Okay, it's still hopefully earning. Okay, let's move forward then. We're doing real good with time. The next plan we're going to look at is the Ministerial Pension Plan, MPP. And like CRSP-DC, MPP does appear on your quarterly statements very much. It is a balance. And in several ways, what happens to MPP, Ministerial Pension Plan, reminds me a lot of Clergy Retirement Security Program. And I'll explain why in a moment, because it does provide two different things. It does provide a lifetime of income, a monthly direct deposit that lasts as long as you do, and if elected, continues to your surviving spouse. And in addition to that, it does provide a cash account balance that you do have control and flexibility. The decisions you make about the lifetime benefit, again, those are going to be not revocable. Cash account balance, more flexibility, more control. MPP balances for everyone have to be invested using life stage investment management. So everyone's using life stage for MPP. And this is a separate balance, and it is fully invested up until the day before your retirement, which for many of you will be June 30th. And then what happens? What happens if you elect, and the first choice is, hey, I don't need MPP yet, I'll wait. But you might need it right away, and this is what becomes of that balance. 65% of it becomes a lifetime annuity, which is just that monthly stream of payments that last one or two lifetimes, different cost of living adjustments. And the 35% becomes this continued cash account balance, still invested, many distribution options. Take it all out at once. Take a partial distribution. Use life stage retirement income. Self-manage that income. This is why it reminds me of CRSP. Those two different components, lifetime income and account balance, similar to what we talked about with CRSP. Now, that annuity is based upon exactly, and we'll calculate it, what is 65% of that balance June 30th. What I've seen most often with that 35%, and I'll show you this later on benefit access, the clergy would just check the box that says, hey, take that 35% and roll it over right into UMPIP. And from UMPIP, you can do anything you want with it, okay? But again, flexibility. You could self-manage this. You could just tell Westpath, hey, send me out $500 a month. You could change that amount. You could take a partial at any time. And later on, I will show you on benefit access, setting up life stage retirement income and the advantages of doing that. So many different options with that 35%. Remember, take care of the tough decisions first regarding MPP, that's 65%, and the CRSP defined benefit. 6 different annuity options. Again, they can be different for MPP than they are for Clergy Retirement Security Program. Different cost of living adjustments can be elected differently for each of the plans. And just to review, when I say annuity, I'm just thinking of, in my mind, the stream, the series of monthly direct deposits that last as long as you do, okay? 1 or 2 lifetimes as elected in your retirement application process. What is that annuity based upon? That's 65%, and for many of you, that will be a substantial balance. The factors that go into converting that to a monthly income, a monthly direct deposit, your age is very important, and we know what that is. The age of your spouse or other contingent annuitant is also very important. What exactly is 65% of that account balance? What type of annuity did you actually choose? 6 different ones, all different. We'll look at them. Okay, what cost of living adjustment did you choose? What is your life expectancy? We will look at mortality tables, and we have a Westpath annuity payout rate. So that's all crunched together to come up with dollar amounts. Now, the next 2 slides, we're going to be looking at some specific dollar amounts. I don't want anyone in the room to think that this is your actual benefit. Okay, this is an example put together by Westpath, our actuaries. I ask, well, what is this based upon? And they say, Bob, this example is based upon a clergy who's 65 years old. I said, very good, normal retirement, I understand. I said, what about the spouse? Oh, Bob, the spouse is also 65. Oh, okay, thank you. That tells me a little bit about it. So, 6 different annuities to choose from, and you can only pick one. And what was interesting, before we went all on benefit access for the retirement process, we used to send out forms. And a lot of these forms would come back invalid because the retired clergy would select multiple options. You can only pick one, and benefit access only allows you to pick one. Now, one thing that's interesting I'll point out is that we don't pay out both columns at the same time. We pay out this column first, the amount payable to you, the retired participant. You die, we pay out this column over here, if elected. Now, if you're looking at this chart, help me here. What's the highest dollar amount you see here? I hear a couple different numbers. I like the 1284 as the highest. Well, what does that mean? What does that mean? It means a life and 70% annuity. This is the lifetime amount, 1284, 1284. Depending upon what COLA you chose, that's going to increase. You die, when you die, 70% of that amount continues to the surviving spouse, $899 in this example. And you might be looking at the $899 and saying, hey, that's not going to be enough income for my spouse. They're still going to have expenses after you're gone. Maybe some will change, but some will go away, but there's still going to be expenses. Let me also look at the life and 85%. And if you notice in this row, life and 85, 2 things happen at the same time. Your 1284 goes down a little bit, but the 899 goes up more. Okay, and what that means is you get this amount, you die, the spouse gets 85%. That's where the life and 85 comes in. So that's 1053. And you might be thinking that's not going to be enough. Let me also consider the life and 100%. Same thing happens. This number goes down, that number goes up. 100% of your benefit continues to your surviving spouse. 6 different annuities to choose from. I think it's very important to understand the choice that you made, right? It's also very important to understand the 5 choices you didn't make, because you could have made them. And this is your opportunity to choose any of the 6. That will go away July 1. And I always like to compare this to, you're kind of shopping for something expensive here. Maybe like you've done this before. Anybody ever go shopping for something expensive like a motorcycle or a refrigerator or a stove or something? And you might go to different stores like me, and do different things and haggle. And the difference here is you can't return this to the store. It's an important lifetime decision. And it would be very easy to pick this if you could just tell Westpath the exact date you think you're going to die. And it would be important to know the exact date your spouse will die. Then we'll help you pick. Okay, but we don't know, you know. And it is the reason often, you know, clergy that aren't even close to retirement, 5, 10 years out, will say to me, hey, Bob, I know what I want to do. I know what option I want. I said, well, that's great, Reverend, but you can't tell Westpath now. How come? How come I can't let you know? Well, I say, sir, you know, in 5 or 10 years from now, what will your situation be like for sure? Will you be married? Will you be divorced? Will you be widowed? Will you be in good health? Will your spouse be in good health? These are things you think about when you make this decision, okay? These are the considerations when you make this important decision. Now, these 3 annuity options really are considered the standard form of payment for a married clergy person. The next 3 are really optional forms of payment for a married clergy person, and really the standard form of payment for a single clergy person. And if you look at the next 3 annuity options, there's only 1 column. And you might say, hey, Bob, I like this slide better. These numbers are much more like it. This is good. I want to pick these single life annuities. I say, well, that's great, you can. But if you're married and pick one of these single life annuities, you need to tell your spouse you're doing this, right? And not mention it when they're not home. They actually have to agree, consent, and sign a waiver, giving up their rights to receive a survivor benefit, and that will be an interesting discussion, will it not? Okay? There might be good financial reasons why if you'd pick this. Like if your spouse has significant employer benefit plans or significant inheritances or other resources, there might be a good reason to pick a single life annuity and get the waiver. But I want you to consider all these options yours, all 6 of these. The reason that these, well, I'll ask you, why are these amounts higher? Single life annuity, 1 person's lifetime. We don't know how long that is actually going to be. And I remember back several years ago doing retirement seminars for folks at the Bronx Zoo that were retiring. And their normal retirement was age 62. And I'll never forget this guy, Joe. I can't tell you his last name. But he had worked at the zoo more than half his life. And he was getting a big fat pension too, because they had a very generous defined benefit and a defined contribution plan. So Joe's in the office, and Joe's filling out the paperwork, and Joe understood all the choices he had, because we were quite clear about it. And Joe was single at the time. So Joe said, wow, I like that big amount there. Put me down for the life only, single life annuity, Bob. And we did. It's his choice, okay? So he's happy, he leaves. 3 months later, we get notified Joe passed away. I say, really? He looked fine when he was in here. What happened? Was he sick? I don't know. He didn't mention anything. He looked fine. We sent out 3 checks, and it was checks then, okay? And that's it. It stopped. Done. No refund. And whatever the defined contribution balance he had went to his beneficiaries, which was his kids, okay? Didn't work out great for Joe in terms of the pension benefit, did it? No, okay? Now, had Joe known that Joe was sick or had an ailment, disease, something bad, he might not have picked that single life annuity. He might have picked maybe one of the 5 or 10-year guarantee payment options, which means payments are going to be made at least for a certain period of time guaranteed. Okay? Now, having said that, keep in mind, regardless of which of the 6 options the retired clergy person chooses, there is no option where it's going to stop for you. But under the 5 and 10-year guarantee, it might stop for someone else. I'll give you 2 examples, 2 quick stories. You see the lifetime annuity here, single life, we don't know how many months that's going to be, how many years it's going to be, that's $15.51. If you consider the life with 5-year guarantee, the one in the middle, the dollar amount drops a little bit. Not a big amount, $11 in this example, not a real big amount, not life-changing. But that means payments are guaranteed for at least 5 years to somebody, anybody. Doesn't matter who, doesn't matter the age of that somebody. So let's say Reverend Joe picks the 5-year guaranteed option. and he lives 23 years in retirement. Good for him. It continues with whatever COLA was elected. He dies after 23 years. Well, the 5-year term is long up. It stops. Second story, second example. Reverend Joe picks the life with 10-year guarantee. You see the amount drops down a little bit again. Now it's guaranteed for 10 years. So he completes it, he lets us know who the beneficiary is, and he dies after 7 years. Wait a minute, the term's not up. There's 3 years left. Somebody is going to get those payments for 3 additional years, and then it's going to stop for them. Now that somebody can be anybody. Age is not a factor. It could be a child, boyfriend, girlfriend, sister, mother, father, church, charity. Guarantee means guaranteed payments are going to be made. He picks 10 years, he lives 15, good, payments continued for the participant. Does that make sense? Those options, all 6 of them. So this is really the standard form of payment for a single clergy person at the time of retirement, but an optional form of payment for a married person. 6 different annuities. And again, what you choose for MPP does not have to be the same for CRSP. Any questions up to this point? Now, I'll ask a question. Well, Bob, what if I pick the 10-year guarantee and the person I put down, my elderly aunt, she passes away before me? I said, well, it's very sad. You can name someone else to receive those payments. Second question I would think of, let's say I pick the life with 10-year guarantee and I have it with my elderly aunt again, but she's tough and she's going to live a long time. She's going to designate a beneficiary if she dies first. So let's say you live 7 years, aunt lives 1 year, someone else will get it for the 2 years. The point I'm trying to get to is guarantee means guaranteed to somebody. So that person that you've named would actually have to name someone too in case they don't live the term. Make sense?
Yes.
All right.
We're locked in.
Yeah.
So if we choose 10 year, and the person I chose as the beneficiary dies 6 months later, I'm still locked into the 10 year.
You're still, yes. The
Okay. It couldn't change to life only.
Yes, a twist on the question is you pick that life with 10-year guarantee, the person that you named dies first, can you switch now to the single life annuity? No, you're locked in. But what you would need to do, sir, Reverend Bob, is pick somebody else to replace that person that died. Yep, that's all. All right, now the second real important decision has to do with an annual increase. And I mentioned before, COLAs are important. Okay, and I mentioned I've seen plans that don't have COLAs. I think even during your active ministry and even people at Westpath, annual increases are very important. You're going to have the option, different COLA options. Now it works a little bit tricky. When you go into benefit access, it's going to be pre-populated with both plans for a 2% COLA. That's kind of the default COLA, but you can change that. The minimum COLA for CRSP is 2%. So everyone is going to get at least a 2% compounded increase in their CRSP defined benefit, at least 2%. MPP, Ministerial Pension Plan, you also have an additional option of a 0% COLA. So you have 0, 2%, 3%, 4%, or a 5% COLA. So you might be thinking, well, Bob, why wouldn't people just pick the 5%? Who wouldn't want a nice 5% compounded annual increase in their benefit? Well, there's a catch. There's a catch. Not a catch, but there's an impact of choosing higher or lower COLAs. And what's nice about benefit access, and we'll do this later if all goes well, when you change those COLAs, you'll see those monthly amounts change and sometimes change significantly because of that COLA decision. So let's look at a couple fun examples here. You have on the right the different COLA levels, and the 2% is kind of the pink one. That's the default, that's right here, going up 2% every year. Let's look at the extremes. Let's say the person wants to look at a 5% COLA, and the 5% is this orange one here. And what that 5% COLA, what the impact will be is right out of the gate, July 1, you're going to get the lowest benefit. right here on the bottom, but every year you are going up 5%. At a certain point in time, you're going to cross over and you're going to end up having the largest possible benefit with longevity, okay? Because of that 5% annual increase. Make sense? So that's the impact of a higher COLA is a lower starting benefit. Now, let's say you're looking at MPP and you say, wow, you know, Bob, in a couple years I can get this inheritance, or in a couple years I'm going to get Social Security retirement income. I just want to have a higher benefit right now to kind of bridge the gap to that point in time. Look at the impact of, and that one here is kind of like red, that's the 0% COLA. 0%, you start out with the highest benefit. And you'll see that in benefit access. 0% is going to give you the highest benefit, but every year it remains the same. It's not going to go up. It's going to be flat. And eventually, at some point, it could end up being the lowest monthly benefit, but you did enjoy many, many years of the higher benefit earlier on. Does that make sense? Now, obviously, why is COLA important? Because of inflation. And I had asked the investment folks at Westpath, I said, I need to talk about inflation with the retiring class. And how come you want to do that? Well, they have to pick COLAs. Okay, so I need some inflation historical numbers. So they gave me a whole bunch of numbers to look at. And I kind of think it's interesting to look at what's been going on with inflation over the last 25 years, kind of in control, what the lowest 10 years, what the highest 10 years were. And they go all the way back almost 200 years here. So that's a lot of data. And if you look back over 200 years, 198 years of inflation data, wow, it's about 1.9% per year on average. Say, all right, maybe that's where that 2% default COLA is coming from, okay? But there are other choices. You know, think about, you know, what do you pay for gasoline in central Pennsylvania? $3 a gallon. It's gone up recently, right? It's going up.
77 at the Sheets.
I'm going there. I'm filling up.
Before you leave here.
I
The
will.
one right up the street.
I'm going to buy some extra tanks, too, to fill up. 277 is good. But like, think back when you were teenagers driving around in these big cars. What's the lowest you ever remember paying for a gallon of gasoline?
25 cents. 25 cents, yes.
25?
Yes.
And that was 1925, you said? Oh, 25 cents a gallon.
1968.
So that's quite a difference. And then, and maybe gasoline's not the best example for inflation, but I think it's the funnest example I can think of anyway. Remember several years ago when inflation was going, not inflation, but gasoline was going up really high? What's the highest it hit out here?
$4.
That was the highest, 4? On Long Island, it was I remember paying, and I only got a gallon, $4.75 a gallon. Yeah. I gave the guy 5. I said, where's my quarter? But that's just one example of inflation. That's why, you know, we want and have the default as 2%. There are other options because you do want a monthly source of income that's going to increase and keep up or outpace the rate of inflation.
Cross over to New Jersey, it goes down by 30 cents.
Is that? Yes, it does.
Yes.
I think.
Or go out to California, it triples.
Yeah, then I got to pay like $19 for the bridge to get over. All right, so just to wrap up, ministerial pension plan. I just want to stress, you know, that first bullet is important. You don't need to do anything right away. You might need to, but you really have up until age 70 and a half to commence your MPP. And if you decide to wait, it doesn't mean your balance is frozen, sitting idle. It's still fully invested using LifeStage. Now, those annuity options, all 6 of them are important to consider. Look at the different dollar amounts. When you go to benefit access, fool around with the different COLAs. See what the impact of changing that COLA is, and think about what you want to do with that 35% that's not annuitized. Again, the option I see, and I will show you later, is a lot of folks are just rolling that over into UMPIP where they can really have different flexible distribution options.
I have a question, sir.
Yep.
And it's, because my wife Karen is retiring earlier than me and I have more years to go, if we're looking at these options here, and I know you can't do this here, it's not fair to you, but what about taking one thing and saying, this is, I'm gonna put the emphasis on now?
Yep.
Since you're still working, hopefully you can be the one later. Can you find a way to do that?
Yes.
With-
Yeah, you're right, it's not fair, I can't do it in my head here, but I understand the question, clergy couple. So they're gonna have really, an extra layer of complexity with their decisions, and they might want to choose something very different than a non-clergy couple. What I would suggest, and we will talk about it in a little bit, maybe call up EY and have that discussion, because they can look at you holistically in terms of what are the income and how those different decisions might be made because of your unique clergy couple status. Yep, absolutely. Now let's talk, I know we've mentioned a couple of you have pre-82. Pre-82 is fairly straightforward. Each annual conference sets the decisions based upon whether you're single or married. At WestPath, we will calculate your pre-82 benefit two different ways, two different calculations. One is annuitizing the defined benefit service money, the DBSM, and the other is a very straightforward math formula benefit. So once we calculate it two different ways, we'll look at the numbers and say which is highest, which is the bigger one. That's the one we're going to send to you. But we'll continue to do that calculation every year going forward, with the intent to switch it over if one, let's say, for example, the past service rate continues to increase. So let's look at this. The benefit you get is going to be the greater of the past service rate or the defined benefit service money converted to an annuity. And we have a nice example here. The clergy has 6 years of pre-82 service. Your conference has set a past service rate. This is something you vote on at annual conference, I believe. $630 per year. So you multiply the years of pre-82 times the past service rate to get an annual amount, just like kind of we did before, and then divide it by 12, and we get $315 a month. Then we take that defined benefit service money, annuitize it annually, come up with a monthly amount, and in this example, we come up with $369. $369 to $315, what are we going to do? Call you up? No. We'll send you the $369. But we'll continue to look at the calculation going forward based upon each annual conference's past service rate. And what could happen in this example is if that past service rate keeps going up every year, that's good. It helps participants. But you might reach a point where the formula benefit becomes greater than the defined benefit service money annuitized. Then we'll flip you over. We'll notify you and flip you over to that higher benefit. It might take some years, but what I've seen is these past service rates tend to go up each year. Does that make sense? Now, in terms of the decisions for pre-82, and I don't think there's a lot of early retirements under pre-82 anymore, but same kind of actuarial reduction, 0.5% per month if you were going out early with pre-82. But the conference sets the decisions for you. Okay, in terms of the survivor benefit, if you're married, you have to provide a survivor benefit. And in terms of if you're a single clergy person at the time of retirement, it has to be a single life annuity. There's no COLA decisions to be made. So if you have a pre-82 benefit, when you go into benefit access, you'll see that right there. Now, let's go into UMPIP, United Methodist Personal Investment Plan. And again, this is a voluntary plan, but for a voluntary plan, we have very high levels of participation, close to 80%. And this plan has always accepted both employer, plan sponsor contributions, as well as participant, employee, if you will, contributions. What the heck is that? And it's always been something of an individual decision. How much do you want to contribute? Okay, some people express this in terms of a percentage of their compensation or a flat dollar amount. You've always had the ability to raise it, lower it, or stop it. You can self-manage your investments. You can use LifeStage. And I'm just curious about that last one. Is anybody, or have you been self-managing your investments in these plans? Yep. Like you've been picking the investments, allocating it? No? Anybody been using LifeStage Investment Management? Okay. Now, very important, and it stays in this room. Anybody just not sure what I'm talking about? Just not sure if you're in LifeStage or self-managing? No? Okay. I mean, the easiest way to find out is just to check your quarterly statements, and it'll say something like, Bob, the investment of your defined contribution, UMPIP, is managed by Life Stage Investment Management. It's either gonna say that, or for you, it might say, it should say, you have chosen to self-manage your own account in your defined contribution account. Okay? You're gonna see different balances on your statement. You might just have one of these. You might have two of these. You might technically have all four of these types of balances. And it's important to understand the source of the money, because depending upon the source of the money will depend upon how it's gonna be treated when you take it out, and potentially offset by the housing allowance exclusion, which we will talk about. So you might see before tax, that's the most common one we see. Those are the ones that reduced your taxable income, grew tax deferred, any investment earnings, dividends, growth you experienced, not required to pay taxes on every year, taxable when you take it out. You might have after-tax contributions in there, which are the opposite, and you don't want to pay taxes on those again, but it's the earnings, which we will calculate for you, that become taxable. Has anybody done Roth contributions in their plan? Some Roth action, good, a form of after-tax, and if that money comes out as qualified, which we'll look at, 100% tax-free. Rollovers really just talks about the portability of these defined contribution plans, moving money from like a previous, like if you came to ministry late, had a previous employer's 401k or 403b or an IRA, and you rolled it over, moved it, kept separate. Anybody exercise any rollovers in here? None, okay, good. So let's look at your before tax. These are the ones that reduced your taxable income, grew tax deferred, okay? These contributions eventually are gonna come out and be subject to taxation on the earnings and the contribution, but potentially offset by the housing allowance exclusion. Roth contributions are a form of after-tax contribution, but what makes them special is that if they're qualified, they're tax-free. Now, anybody have after-tax money in this plan? Some of you do, okay. What makes after-tax interesting, you've already paid the taxes on it, so that's good, but it's the earnings on that money year after year compounded that the government says, well, that's what we want taxes on, and Westpath will calculate the earnings, because you don't want to pay taxes again. Now, the Roth, in order for it to be 100% tax-free, it's got to be qualified. What makes it qualified? A couple things, and they're fairly easy to get to. The first Roth contribution, not everyone, but the first one had to be in the account for at least 5 years, okay? And you got to be at least 59 and a half, or in the event you die or become disabled, you have access to it tax-free. But if these things are in place, that's tax-free income in retirement for that participant, okay? Now, rollovers have always been accepted from different types of plans. And you don't see, folks changing jobs as much in a church plan as you would in a corporate plan. But this is a very common transaction, these rollovers, this moving money from one plan to another plan. And always that's going to be kept as a separate source of money. Now, this next slide, I'm not going to go through everything on it, but I am going to talk about the concept behind it. Reasons to keep your money with Westpath. How do I say this nicely? Be careful, folks. Be careful with your money, because I've seen it time and time again. There's a lot of people out there that I don't trust financially, salespeople particularly. There might be folks encouraging you, asking you, wanting you to do a rollover of your money out of Westpath, and they might not have the full story. And it might be a good idea, it might not be such a good idea, but there's, I think, some compelling reasons not to do that. The services that we have, the sustainable investing philosophy that we follow with our investments. On the bottom, the ability to take out a loan in retirement. If that money's gone, you can't do that. And that's an important option, that retiree loan option, which we'll go into when we talk about housing allowance exclusion. The third bullet is really important. And I got to say this carefully, clergy housing allowance preservations. Rollovers out of Westpath administered plans may not be eligible for the housing allowance exclusion. So be careful. If you were to roll money over out, and that's fine, but just know where you're going with that money. Ask questions, okay? Don't be afraid to ask questions. Be like Bob. Say, what's in it for you? Are there sales charges, commissions, loans, loads? How will I get this money out? What type of investment is it going into? What is the goal and what types of securities? Does it match my goals, not your goals, the person trying to get you to roll over? Okay? Ask about expenses, transaction fees. And there might not be none of this bad stuff, but there might be. I've just seen too many times people say, oh yeah, I rolled my money over out. Well, where'd you go? I don't know. What type of investment? I'm not sure. What are the fees? I didn't ask. I said, well, that's not really that good. Okay, you want to be prepared, and there might be very good intentioned people that want to help you, but often you might encounter people that are more interested in helping themselves. So be careful. The sharks will be circling. Some of you might have substantial balances built up. So just a word of caution. And we do have a rollover area at Westpath. If you ever are concerned or have questions about what you're doing or where you're going, please feel free to give us a call. Now, the distribution options. I mentioned, again, a common theme. You don't need to take out your UMPIP right away. It's still invested for you. Again, that 70.5 when required minimum distributions have to be taken out. But you do have this flexibility. You could take out a full lump sum if you need to. You could take out a partial. You could take this out in installments. You can use life stage retirement income to calculate how much we think you can take out on a monthly basis to last your lifetime. And again, any remaining balances upon your death do go to your designated beneficiary. Often that would be a surviving spouse. Surviving spouse passes away, again, it would go to who's ever designated. Often that's going to be children or charity or church or relatives or somebody. Okay? Now, a little bit, and I just want to mention, with required minimum distributions, or RMDs as they're referred to, don't be overly concerned about missing this, because Westpath and other financial institutions will keep track of this very carefully, because it's important, because the penalties are severe if you don't take out your required minimum distributions. The penalty is 50% of what should have come out, so that's nasty. Okay, now, keep in mind, let's say you're looking at a normal retirement age 65, so you really have about 5.5 years not to do anything. And the money, when I say the money, UMPIP, 35% of MPP, the CRISP DC account balance, that money is still earning, still growing. But again, the government eventually wants you to take something out. And that's at this magical age of 70.5. Now, I'll start off by saying, most participants that I've seen are well into it by then. They are taking out enough money to satisfy the required minimum distribution. But if you're not, Westpath will notify you, hey, you need to take out something more. Or if you just want to take out the absolute minimum for whatever reason, we will calculate that for you. So this applies to your DC balances, and you have to do this every year. Technically, you have until April 1st. Of the year following the year you turn 70.5 to take out that first RMD. But in that same year, you would need to take out one for the current year as well, so to that year. So, any questions, call Westpath. And if you really are interested in this, and I mean this seriously, I know we pick on the IRS sometimes, right? We sure do have fun with that, right? But they do have a really, and I've read it, publication 590 at irs.gov, and it's really a very well-written book about required minimum distributions, and we follow the exact charts in that book in terms of calculating the required minimum distribution. So if you get to the point where you need to take something out, we will notify you. And this is important, and other financial services companies do the same thing. They got to let you know. Like we used to send out, or I used to work for 12 years, send out RMD notices all the time to people. You got to take something out? Send out a second notice. Got to take something out? They would ignore it. Third notice. Got to take something out? They ignore it. Finally, and I called it the Christmas check, because it was late in the year around Christmas time, we just mail them a check. Then they call you. How come you sent this money? Why'd you send $4,200? Well, that's your RMD, required minimum distribution. If you didn't take that out, you would have paid a 50% penalty. Oh, wow, thank you very much. Click. So it's important, and we'll notify you. Don't ignore the notices. But we take it seriously. The penalties are severe. And again, most folks are well into it. And the thing I mentioned too, if you're using life stage retirement income to calculate how much you can take out to last your lifetime, it's going to factor in RMDs and take out enough to satisfy that. Make sense? Great. Okay. Now, taxes. When we go through benefit access later on, you're going to see for each of these plans, and it gets a little redundant, you'll see that quickly, but you have a decision to make about, do you want taxes withheld? Okay, these payments are not subject to SECA taxes like you've currently been experiencing. But your retirement income, you could say, no, I don't want anything withheld, or yes, I do. If you have an accountant, a tax person, a CPA, someone you trust financially, ask them. Say, hey, this is a big status change for me. I'm going from active for many, many years to retired. What do you think I should have in terms of withholding? And they can give you some guidance. But knowing that you can change that at any time. Some people will change it after the first 6 months of retirement for the full year 2020, for example. On partial or full distributions, there is no negotiation about withholding. There is no option to say, oh no, I don't want any withholding. So if you're taking a partial or full, we and other financial institutions are required to withhold 20%. This is not a penalty. This is just like taxes get withheld from a person's paycheck, it's a credit, a prepayment of taxes that are going to be due, and you might, depending upon how you file, get some of that money back, okay? On RMDs, the required minimum distributions, it is only having 10% has to be withheld, not the 20%. So I think that's kind of interesting to point out.